Okay, here we go with Chapter 2, Part 2. Recall that you're a new accountant and you're taking over, and the original accountant's done a good job, and you're finding all kinds of things in your desk. And you look, and this is before you showed up at the company, but you're looking at these transactions, and transaction number one, in, in each one of these, the transaction is going to be described to you. It's one or two sentences, that's it, describing a business transaction. And what you've got to do is, at this point, is read the analysis. This is how the accountant analyzed it, review the rules, and then confirm that the journal entry is correct. So typically the very first thing, a new company is going to issue stock. What happens is the owners put in money into the business and they get common stock in exchange. In this case, the owners Joe Sharp put in $80,000 and received common stock. When you analyze that, you've got to read that and go, okay, according to that, 80 cash is being increased and the stockholders' equity is going up. The common stock is being increased. Now you go over and look at the rules on page 10. How do you increase any asset account, including cash? What do the rules say? Debit cash 80,000 and common stock. Look at the rules. How do you increase common stock? You increase it with a credit, and credits are written the second line and they're indented. Cash up, common stock up. Transaction number 2. Purchased office supplies, $600, and furniture, $1,400, purchased on account. Went to an office supply, bought office supplies and furniture on account. Recall that means they didn't pay cash, they charged it, accounts payable. So here's the analysis. It's called a compound entry because there's actually 3 accounts involved here. We got more supplies, we've got more furniture, and we've got more debt. We charged it. We've got more accounts payable. That's the analysis. Look at the rules. How do you increase asset accounts? You've got to be able to identify that office supplies are valuable. They're an asset. Furniture is an asset. You increase the 2 asset accounts. You write those first. And you increase the liability account, accounts payable. The entry must balance. This $2,000 is $2,000. The entry balances. Asset up, and liability, accounts payable. What do the rules say? $2,000 credit increases accounts payable. Accounts payable, one of those liability accounts. Transaction 3, company paid $25,000 and purchased some land. The analysis of that, what you've got to think about, what this accountant noted here was, well, hey, we've got more land, less cash. They're both assets. Debit land to increase land, credit cash to decrease cash. Transaction 4, the company collected $4,000 cash for services performed. They earned it. They made some travel arrangements. The analysis, got more cash and we've earned more revenue. Go to the rules. How do you increase the cash account? We've got more cash and we've got more revenue. Debit cash to increase it. Credit service revenue, $4,000 to increase service revenue. Transaction 5, we made some travel arrangements for a client, and he promised to pay us a little bit later this month. He was going to pay us $800, and then next month, the remaining $400. So what we've done is we've earned $1,200 and what's going to happen is we're going to be paid later for that. Okay, that's the analysis. Someone owes us, one of our customers owes us money. That is, look at the definition back a few pages, accounts receivable. We're owed money. What's the rule here? We've got more accounts receivable. We sure do. It's an asset. Increase it with a $1,200 debit, and we've got more service revenue. Accounts receivable up, service revenue up. Paid rent, $1,000. Analysis, cash was paid. We've got more rent expense and less cash. Go to the rules. Increase rent expense, decrease cash. This is starting to look easy, isn't it? Transaction 7, paid a salary. We've got more salary expense, well, less cash. Go to the rules. How do you increase any expense account? Just like the rent expense, a debit increases the expense, a credit to cash, the asset account cash, decrease. Went over to OfficeMax or somewhere, purchased some, oh no, we didn't purchase, we paid. We paid $600. Remember back on September 3rd, look back up on the previous page, we purchased a bunch of office supplies, $600. Remember transaction 2 it was. Well, now here it is. Later in the month, we get the checkbook out and we cut a check. That's what this means. We cut a check. Here's the analysis of that. We're paying something that we owe. As a result of that transaction, we've got less cash and we've got less accounts payable. Two things going down in this case. Decrease accounts payable, we do not owe that $600 any longer, and decrease cash. Cash is going down. Remember that September 8th transaction where we sold it on account and that customer promised to pay us $800 later in the month? Sure enough, his check comes in, more cash, but we're not owed as much. Increase cash by $800, decrease accounts receivable. It's an asset account. Decrease it by $800 because we're not owed as much money as a result of that. Transaction 10, we paid, when you pay in advance, and that's what this is, 12 months insurance policy, paid in advance. Remember prepaid insurance? Go over and read that paragraph again about the prepaid insurance. When we pay insurance in advance, it is an asset. Now, as time goes by, we're going to use that up, but right now, it's an asset because, well, if we sold the company the next day, wouldn't we point to that and go, oh, by the way, dear buyer, we've got something for you. I paid a year's worth of insurance for you. That's valuable. Or we decide, well, listen, we want to cancel it, give us our money back. We don't want that coverage. If we can get out of it, we do. When we pay for something in advance, it's going to be a prepaid insurance in this case. Over time, and you'll see, starting in the next chapter, what happens as time goes by, let's see, what is this, 12 months, $2,400. You're going to see as each month goes by, we're going to whittle this down. We're going to decrease the prepaid insurance account by $200, $200 each month as we go through the year. But right now in the beginning, it's all an asset. Cash goes down. Transaction 11, oh look, paid dividends, $500. Cash is going down. Go back to page 10. How do you increase dividends? With a debit. Dividends up, cash down. Received a telephone bill. Dates are important on this. September the 25th. Okay, that's a bill for this month. Now, we might not pay it, probably won't pay it until October sometime, but that bill came in, okay, and in this case, telephone bill, okay, it's called part of the utility expense. Utility expense up, and we're not paying the bill yet. We'll probably wait. Since we owe it right now, what are the rules? What do we do? What we want to do is increase utilities expense and increase utilities payable. We'll pay them next month, but right now we do have a debt, and it's to pay the telephone bill. Transaction 13. Oh, look at this. We had a customer we did some work for, maybe traveling around the world, going to be out of town for a while, paid us in advance of us earning it. Look at the analysis here. We're paid in advance. That's unearned revenue. Now we're gonna earn it probably next month, but right now it's paid in advance, and because we have not earned it, it is a liability account. If you go back to the chart of accounts, you'll see unearned revenue, say revenue account, liability account, sorry. Cash goes up, unearned rent, that liability account goes up. We owe them a refund until we do the work, until we provide the service. Okay, now, those were the journal entries, 13 journal entries. Recall, what is it that we do after we make the journal entries? We have to post each and every one of those debits and credits. Every one of those journal entries has to be posted to the appropriate general ledger account. Here's the general ledger. Here's cash, accounts receivable, prepaid insurance. Every account will be represented here. So let's look at these. Notice we've got the date, the journal entry number, journal entry 1 through 13. Okay, now let's do the first one. Let's go back. Journal entry number 1 on page 16. Take a look at it. On page 16, we debited cash 80,000 and credited common stock 80,000. Let me just pop it in there. There it is. That first one, debit cash, credit common stock. That was the journal entry. Now we post it. Here it is, journal entry 1. Post that $80,000 as the debit here, and then change the account balance. In this case, from 0 up to 80,000. Now let's see. Where's common stock? Common stock, where's common stock? Common stock is another account that changed. Let's just pop over here. There's common stock. You see it? Journal entry number 1, we post it, meaning we reflect it, we transfer 80, that we record it here as a credit, and then change the account balance up to 80,000. Journal entry number 2. Journal entry 2, let's peek at it. Here it is. Okay, we debited office supplies. We debited office supplies, furniture, and we credited accounts payable. Now we must post all of that over to the general ledger. Okay, office supplies. Where's office supplies? Here we go, right here. Office supplies. Journal entry number 2. Post the $600 debit. The balance goes up to $600. Here's the furniture. Journal entry number 2. Post the $1,400 and the balance goes to $1,400. And happily for us, accounts payable, right here on the bottom of this page, journal entry number 2, post the credit to accounts payable and change the account balance. You see how that works? We do that for each and every one of those journal entries. The journal entry number is shown, the posting is shown, and the account balance. We do that for each and every one of the journal entries. You should track this through, take a look at it, confirm that each and every one of those journal entries got reflected right over here. Now, the accountant, the previous accountant in our story, also posted all of those journal entries onto a T account page. Now, T accounts, let's see, here's the cash, 80,000, when cash went up and stock was issued. And here's the credit to common stock. You can see that each one of these, the second one, let's see, where was that? Oh, office supplies, 600. Where's furniture? Here it is, furniture, and accounts payable right there. All of those are shown over here in the T accounts as well, but notice that T accounts don't give you the balance every day or the change of every transaction like the general ledger does on pages 19 and 20, but what you do get at the end is the balance. Now if you compare that balance, you'll see 54,900, accounts receivable 400, prepaid insurance 2,400. Those T accounts, the ending balance, will of course agree with the general ledger balance. Now, as we learned earlier in the chapter, after posting all of the journal entries to the general ledger pages, you prepare an unadjusted trial balance. Called unadjusted because, well, chapter 3, we're going to make some adjustments, about 8 different adjustments. But right now, you recognize these numbers? We're doing nothing but taking the account balances as shown on our general ledger. Go back and check it. What's the account balance according to the general ledger for service revenue? 5,200. Common stock, 80,000. Well, it's just, there's the 80,000, there's the 5,200. The ending account balance is on those previous pages. It balances. It doesn't prove there wasn't a mistake, but it balances. Now, this is sort of leftover from earlier in the chapter. What about errors? Errors happen. Accountants make errors. What happens is you've got to correct it. And in this case, here's a transaction. Here's a case where rent was paid for $400. And this is what should have happened. Rent expense up, cash down. But let's just say the phone rang or some other distraction and the accountant made an incorrect journal entry. The accountant inadvertently debited utilities expense instead of rent expense, but credited cash correctly. You see the transaction, balances. If that were left unchecked and uncorrected, well, it wouldn't cause a problem up in an adjusted trial balance because it's still balanced at 400 and 400. But what has to happen is, and the best way to think of it is you've got to undo the mistake. It's just like if you take a step to the right when you should have taken a step to the left. First thing you got to do is step back where you came from and then step the direction you intended. That's the concept here. Notice that this undoing of this error, here's the error. Well, you can bring it right, but you can bring the account balances back to where they were if you just reverse the entry. You credited cash, well, debit cash and put cash back up. You debited utilities expense to increase it, well, you could come down here and just credit utilities expense. Get the account balances back to where they were before the mistake was made. And then you would make it the correct way, the way you should have done it, in the beginning. Now, sometimes, and there could be a question about this, if the mistake is made, notice that actually the cash part of this was okay. The mistake was right here. Should have been debit to rent expense, but it was actually to utilities expense. But the credit to cash, the $400, was really correct the first time. So you wouldn't necessarily have to undo that right here. What you could do is say, well, you know what? The cash account part of the entry was correct. It was that the wrong account was debited. I debited rent expense. Okay, should have debited rent expense, but instead I debited utilities expense. So this is be kind of a shortcut once you get good at making mistakes. Oh no, that's not what I mean. Once you can take some shortcuts as long as you know what you're doing. In this case, the goal here is decrease utility expense. Should have never debited utility expense here. The way to correct that, we could just credit utility expense to bring that account balance back down to where it was before the mistake, and increase rent expense by $400, and not even bother with the correcting the cash going back and forth, because there really wasn't an error involving cash. Okay, homework assignments. Talk about that for a minute. You're going to want to read over this. Let's see. We'll read this carefully, because you really don't want to, when you take the quiz on the homework portion of it, you don't want to miss it because of a simple thing like adding the $sign or a comma or something like that. Let's see. McKinney. Oh, look, here it is. Not surprisingly, what you're asked to do is make journal entries, and notice that along the way that yes, there's blanks, and you're familiar with this. This is question number 7 is going to ask about the account being debited here. Okay, 4. Remember, this is the most important chapter in the book. You should do each and every one of these. Okay, goes on for several pages. Over here. And of course, the general ledger. I give you several pages of the general ledger so you can practice posting. And I give you some check numbers. T account. Now the T account, if you notice, these are all the September transactions that the previous accountant did. You would update these. You would update these just like you updated and continued on the general ledger postings. And of course, an unadjusted trial balance. I've given you some check numbers. If you do it all the way through, if you hit these numbers, then you know that you're in pretty good shape. Now the multiple choice questions that follow are on page 32. If you read through the syllabus on the Guide to Success, you know that you can expect to see similar, not exactly, similar questions on the exam. And so it's important. Here we go. Practice questions. Remember, We're going to have discussion postings on this. And that's how students are going to help students with some of these questions. And of course, I'm always available. Let's see, we've got 20 of those. And you want to take your time. You want to take your time with this chapter because it's the most important chapter in the book. You've got to get it down. So work through it, and you let me know if you have problems.